Okay, good morning and welcome. I wanted to have a chat today a bit about some work we've been doing, myself and my business partner and wife actually, at the Resilience Centre. We basically, the Resilience Centre is a social purpose business we set up about 5 years ago now, after going through a bit of an epiphany with early days of transition, 7 or 8 years ago. And we set up, both myself and my wife have over 25 years experience in energy development, and particularly renewable energy development and planning in the UK, and that was our career, that was our long-term career, and we set ourselves up really in business to try to really remove some of the barriers to community energy development. We saw that we had the skills and expertise to do this. We could see what some of the barriers were, and we basically thought long and hard to see really the work we were doing with transition towns and really what some of the pitfalls were really in trying to get projects on and move them on. And really, I suppose the aim was to how do you go about right back to the bare basics? How do we take this whole concept, community energy, strip it right back to the basic fundamentals and maximise the benefit to communities? How can we do that? And we looked at it very much from our professional experience of projects and experience of seeing larger commercial renewable energy projects and try to learn some of the lessons that they have made over the years. In terms of our own business, we reinvest all of our profits back into basically a rolling fund for the next project and take this forward. We're currently working on about 12 community projects, mostly in the southwest. Okay. Well, just wanted to chat briefly about some of the challenges of the projects we're working on, and the way we've approached it very much in terms of trying to remove those barriers of projects is to look at joint ownership. Really, we've tried to facilitate and use our skills and expertise to, basically provide what is in effect a low risk and low cost entry for communities and landholders in terms of trying to remove the majority of the actual upfront planning and development costs. So typically, say for a community half megawatt wind turbine, looking at to get that project right up to development, to construction, we're talking maybe 180 to 240,000 pounds. We're trying to reduce that cost down to about 45 to 60,000 pounds for communities. But in effect sharing the equity with them. So we're basically doing a lot of the work we do is for nothing in exchange for a proportion of the equity of that project if it's successful. And we've done that by backing ourselves. In effect, we after 20 plus years in the industry, we had pensions. So we've basically cashed those pensions in. We put them into a self-invested pension scheme and invested in community projects. So we've done that basically we thought, well, if we couldn't back ourselves, then who would? So let's do it. The key to this really is that, I suppose, in our experience, is to making sure that we only take forward projects that have got a good chance of success. And I think that's a key thing we see with a lot of community projects. Quite often, there's a community with a fantastic aspiration to want to take a project forward with perhaps limited resources and sites, which may not necessarily be the best site. But there are landholders and farmers who maybe don't have the capital in that same area, but perhaps would like to take a project. So quite often we act to try and facilitate, to bring parties together. So we're working in Devon with a parish council and a small local farmer, and we brought them together in a joint venture partnership, and we'll then deliver that project on behalf of those parties. And typically, we've got quite good resources. We've got a GIS system. We can screen sites, particularly wind sites, but also solar, and we can look at some of the constraints. Typically within 4 to 6 hours, we'll know if it's worth taking that site forward. We do see an awful lot of projects that go through the planning system, community projects that perhaps should have been screened out in the first couple of days, perhaps. Okay. Okay, just a bit more on some of the challenges. I think the key to community projects and certain experiences come up with a fairly simple model, really. Don't make it too complex. Really, because at the end of the day, the whole thing is trying to maximise the benefit for that community. Quite often it's very easy to end up reinventing the wheel on planning on community projects, planning and development, and certainly the technical delivery up front. And whilst it's exciting and interesting, and certainly we need to engage with the communities, quite often, we will, even ourselves, we will bring in some of the best experts in the UK to deliver certain aspects of it. So particularly things like noise or ecology, where we know at the end of the day, most of the regulators in the UK will apply almost a one-size-fits-all to projects, including community projects. And if you haven't got that nailed down, that community project is going to struggle. So it's really making sure we bring the key experts in. So I'm spending any money we spend it very wisely. And the key thing, again, is just getting everybody to pull together. And I suppose we see ourselves as a skilled third-party equity partner to try to identify some of the pitfalls early on before people get to them and try to basically remove them from the project. I think the other key thing we're seeing really is this whole issue about some of the challenges about proportionate approach. It's been mentioned already about a national planning policy framework, but there's no definition in the national planning policy framework of proportionality. It's not defined. So quite often, regulators, because they are planning authorities, will fall back on that and they'll just apply a blanket condition or blanket approach to it, which means, to be honest, it affects community projects more disproportionately because they're the ones with the least resources. They're the ones who quite often it's a smaller project. So that it is a big risk we're seeing in these projects. And I think then also quite often then the planning conditions that are applied, even if we're successful and get over that final hurdle, again, we're seeing almost a one-size-fits-all in terms of conditions that can almost hamstring a project through its operation. Okay, so that's some of the constraints and pitfalls. But I think on the success side, well, we've been fairly successful. We've got 3 projects through planning now, 3 half-megawatt projects, and so we've got another dozen or so projects currently coming through the pipeline. I think the aim of all of our work is try to ensure communities make the best use of available funds. So we typically deliver projects for 12 to 25% of the actual development costs for 50% of the equity to those communities. We try to ensure that landowners are engaged and fairly rewarded, because at the end of the day, again, communities seldom achieve a good project without bringing the landowners on board. Even to the point where landowners quite often will see an opportunity that's been identified community, and some of the certainly wealthy ones will take those projects forward on their own rather than working with the community. So we're encouraging landowners to work with the communities. And a lot of them actually, to be honest with you, smaller farmers see it, they're having a real epiphany as well, because a lot of these farmers, smaller farmers, are out on their own, working on their own most of the day, and very few of them are engaging with their community. And we've seen a massive epiphany in some of the farmers we work with. Actually, it's engaging the community with their food production as much as their energy. Okay, and I think the other thing we work very hard at, and I think it's not just ourselves, but a lot of community projects, is really facilitating the social capital and bringing together the skills, and particularly we've looked at projects from to a certain extent, I suppose, from what people might see as very hard-end financial aspect. We've looked at the value you can create in a community project. And whilst, as I said earlier on, the planning and the development is quite exciting, because that's the bit that's the unknown, it's the gamble, it's the risk, but it's not where the key social capital is created. The main social capital is going to be created in the construction, the support services, the operation of that project. The actual planning and development is probably less than 1% of the total value of that project in its life. So whilst it's very easy to concentrate on that upfront planning bit, the development bit, which is the exciting bit, for communities it's really important they look downstream. Okay, maybe we're taking risk in saying, well, this project may not come off, but if you've got the community behind you, there's a good chance that project's going to come to fruition. Okay, and the other thing well, a couple of things on the social capital. We've set up a joint venture community construction company, Forest EPC. We've also negotiated a framework contract with one of the biggest German solar PV manufacturers, so communities can buy direct from that factory rather than going through third parties and paying a markup. We share legal documents, financial models to allow local service companies, accountants, bookkeepers to actually manage the projects. And our model is very flexible. We're working on multiple equity partner projects where you've got communities, landowners, and ourselves involved. Okay. Right, going to the, I suppose, the nitty-gritty. How do we share this value that's created? Well, typically, when we get a project through planning and development, we look at crowdfunding it. We're not a cooperative, but we basically have very strong cooperative values, and we look to try and retain as much of the value in the local community. So by crowdfunding a project, giving people a reasonable return, 8 to 9% typically, about 38% of the gross value created in the project will stay in that local community. Typically, we do see some cooperatives where they've funded the development cost, and then they go and debt finance the capital with a bank, and 50 to 60% of the value of that project then ends up in the hands of the bank. And you think, well, let's focus on the easy wins. And I think Agaman said earlier at the beginning, if we can do this, we can fund these ourselves. We shouldn't be going to the banks to get this. People have pensions, they have investments, they have savings. It's trying to work. We've been working with Abundance Generation, looking at how we can perhaps redirect that local community money. In terms of joint equity partners, that's ourselves, the landowner, the community. Typically 23 to 25% of the gross value ends up going to those parties. The community, on every project we set up a minimum of 4% of gross revenue going to the community fund. Sort of half-megawatt turbine, that's about £20,000 a year, going to a no-strings community fund with a community panel that just decides where that money goes. As I said earlier, we look to trying to set up the social capital, particularly on the installation, the construction, the operation and the maintenance. The operation and maintenance is the long-term benefit value. That's 16% of the gross value of a project going out on that operation and maintenance. We're talking to looked at the apprenticeship frameworks. There are apprenticeship frameworks out there for wind turbine maintenance, for solar panel, solar farm maintenance. We can set those frameworks up with communities. They can train apprentices. We share standardised documents, as I said earlier, to allow local service companies, bookkeepers, accountants, local lawyers to help manage these projects. That's another 7% of gross revenues. And then we've been working very closely with Co-op Energy as well to try and close the loop on the energy provision. So in effect, you can buy back the energy from the scheme. If you invested in the scheme, or even if you haven't, you can sign up with Co-op Energy. We sell the surplus power to Co-op Energy. So just quickly as a sort of a pictorial, that's roughly how it slices up in terms of the whole project life cycle value created. Community investors getting the bigger chunk, operation and maintenance, the equity partners. But typically we're working on the projects. We've got a working example in the Forest of Dean where we're based, and we've got another 2 projects in Stroud. 70 to 80% is our target to retain of the whole value of that project in the local community. So that's it. Okay. Thanks.